Hey everyone, I just wanted to call your attention to the disclaimer today. This is for educational and informational purposes only. This is not investment advice. We are not registered investment advisors. You trade at your own risk. I highly recommend that anyone trades for 6 to 8 months after learning anything in a paper trading account. Otherwise, better to seek a professional. To the extent that you make use of the concepts with the presentation material, you are solely responsible for the applicable trading and investment decisions that you make. Thank you. Hey everybody, I wanted to start a new series where I just kind of look at a few stocks, nothing too specific in terms of trade ideas, but things that kind of, get you thinking, thought-provoking ideas, and I'll pick out a couple stocks because everything really relates back to the stock in my view. Everything you do, all roads lead back to the stock, right? We're trading options, they're derivatives, they derive their price from the stock price. And of course, the stock price is directly related to the underlying company. So everything comes back to the company, right? So it's something that we always want to keep in mind. And that's something that I always push in all my programs, certainly in week one of the major programs, is quality, quality, quality. So, but I'd like to do a really quality name. I'd like to do some fun names. I'd like to do some even more speculative names. So we'll leave it pretty open. But keeping in mind that it always comes back to that. So we'll look at Amazon. This is Amazon today. So this is the name that I've really liked for a while. Reasonable valuation, as we'll see in a moment. From a chart perspective, starting to kind of coil quite nicely. We got this pennant pattern going here. It looks like something's got to happen, right? It's either got to break to the downside or it's got to break to the upside. We don't know which one, but we're trying to build our thesis. And if we look at the fundamentals, we can see that the price earnings ratio down around 36.3 is really a low point pretty much over the last 5 years. So that's very, very nice to see. And you can look at, there's some stocks out there, like a Procter & Gamble, 24 times forward earnings, 23 for Coke. There are some kind of tame sort of safety, reliable stocks, historically very kind of steady stocks that are trading pretty expensive. So an Amazon at 36 forward earnings isn't bad. I think it's around 44 trailing. That's pretty good. Return on invested capital, really starting to head in the right direction again. Free cash flow margin, I like to see that kind of around 10%, but we can see that we're heading right back towards that number where we were at kind of in the 2020 period there. And then the price earnings to growth, which I think is very, very important. I like to see that kind of, for a company like this, I think 1.7 is very reasonable. Forward is 1.4. I think that's very, very reasonable for a company like that. We look at the skew. We look at the term structure first. So this is showing you, how expensive are options. This would be sort of your typical over the last 90 days, high percentile, 90th percentile, 10th percentile. We're definitely trading on the high side of things, right? So like many things these days, we have to consider different kinds of strategies because of where we are in the term structure in terms of how expensive options are. And then of course in skew as well, we can see that the skew is nothing too crazy. Early August, you can kind of chop that off there because that was a little bit on the extreme side in terms of puts being very, very expensive. We're kind of back to the higher end of the range. So puts expensive, calls really not too bad. I looked at the shape, really kind of typical sort of for the last 52 weeks. So nothing too much jumping out at me right there, but I'd say given all this, in aggregate, you probably want to look at call spreads. You probably want to look at things like, maybe a risk reversal. We have one of those on in the community that's doing very well, making some money. We'll see how it goes. It's sort of, using some downside to finance some upside. That's kind of a popular trade lately for me, just because I feel that people are looking at the downside of things, the left tail, and they're forgetting about the right tail. So to me, that makes an interesting proposition for playing upside. And then if I look at our MTI indicator, which we use in the program, it's starting to shape up a little bit. If you take out the volatility dampener, we're probably about a 4 out of 5. And I think the volatility dampener these days is a little bit kind of skewed by this, by the election, by a few things that maybe are skewing more caution, and we're seeing that play out in the VIX, in some other asset classes, certainly in rates vol. So I'm not saying to ignore that, but if you kind of back it out, it starts to look pretty kind of interesting. Okay, so the next stock here, Lululemon. So this is a fun one. I mean, not that fun if you've owned it from the 500s down into the mid 200s. But yoga pants seem to be back in play again. I keep saying the yoga pants are back. So we've had this kind of terrible low here in the face of really kind of solid balance sheet, really good numbers overall, a couple little things that little missteps for the company. But this is one of those companies that really stacks up nicely on the fundamental side of things. And we can see it's been sort of meandering up, and it's kind of broken out recently above 300 again, still below that 200-day moving average. The MACD looking good. I like to see that. And then fundamentally, we've got a return on invested capital, 38.8%. That's really nice and high. Return on an equity, very high. Gross margin, I mean, I like to see that kind of, above 40%, so 58 is great. Profit margin, I like to see above 10%. 16 is fantastic. Free cash flow to net income, great. And then stock-based compensation. So you look at some tech stocks in particular, you look at names like Qualsys, whatever, really lean on that stock-based compensation. So that's one of the things you got to look out for. And 5-year average for Lulu, 7.1. It's not stunningly good, but it's actually very good. And this is a company that is now stepping up their buybacks. I like to see that. I like to see companies that believe in the valuation of their stock, and they're stepping in and talking with their wallets, and they're starting to buy back. Look at this, some big buybacks in Lululemon. That is a nice thing to see, right? I love cannibal stocks like Visa, which I think I'm going to cover next time. Some of the couple home builders, there's some companies out there that just buy their own stock, and that's terrific for shareholders as long as they're buying reasonably priced stock. So very interesting play from that perspective. And then lastly, term structure, it's not that expensive, right? Going into earnings, not that bad. Out to December, really not a crazy high price stock. Gets a little bit higher, but nothing outrageous into January and beyond. So I think this is an interesting play. I think you could get in here, pick up some longer term call spreads, maybe a little bit higher. You could do some risk reversals as well, and play for the upside. If you position yourself to own Lululemon down in this kind of 250 range and use that to finance some upside, that's kind of a win-win situation. You don't have to get in right here in case it reverses down, but it'll get you in at a price that is really fantastic for a company of this quality. But if it keeps going, you're going to benefit. So these are the kinds of things that we look at in the community, in the Cash Flow Insiders community Discord. So look into everything we do. We've got all kinds of programs, and I hope you enjoyed that. We'll see you in the next video.